it's my pleasure to introduce a very distinguished panel. About a year ago, Luca and I had a first conversation, and that's when Luca was developing the idea around today's conference. And I was very impressed with the people that Luca assembled. Obviously, moving it online was a heroic act, and I think it's wonderful to do this. So it's a real pleasure. It's an honor to be introducing the panelists. I believe that 3 of my 4 panelists have arrived, and so I think what we'd like to do is, my panelists are Hui, Jeff. Sorry, I'm probably mispronouncing your name again. You'll correct us in a moment. Jeff, Silvio, and then I believe, let me see, where are you there? Yeah, Slil, I'm probably mispronouncing your name too. And I think we're waiting for Ben Davey. Hopefully he'll be able to join us too. Now, each of these are, hi Slil, good to see you. Each of our panelists bring a very distinguished career to them. I think it'd be nice to very briefly, if each of them very briefly introduce themselves, but they all have thought about today's issues in very different but deep ways. So I think we'll start sort of with opening comments by each of the panelists, and then I'll be happy to shoot a few questions, and we'll make it interactive as we go along. Since I'm not a moderator, I don't. Let me just see. If do we have the hand?
Yes,
so sorry, question for Luca. Do we have the hand raising facility on this Zoom call?
Yes, we do.
Yes.
We do. So I think as the panelists are discussing, if there are some burning issues, we can take 1 or 2 hands before we move to the next panelist. I hope that that's agreeable to all. Now, there is no defined, at least I wasn't given a defined order. So Hui, you somehow ended up in the first top left panel of my screen. So that makes you a perfect candidate to start off the conversation.
Thanks a lot, Thomas. And so let me share my screen, and I have a few slides. Hopefully, we'll be able to see them. Perfect. Do you see my screen?
Great.
Yeah. Okay.
Yes.
Great. So thanks a lot, no, thanks a lot, for having me today. That's really great, to be on this video conference. So I'm Hui. I'm a co-founder of CFT and CEO of the Disruptive Group. In terms of background, I used to be an entrepreneur, then banker, then I'm back in my entrepreneur days, again. As a banker, I used to run a group at Citibank. Before that, I used to be head of macro structuring at RBS. Before that, SocGen. And but I actually started as an entrepreneur. And as an entrepreneur, I used to be CEO of UKB. And UKB used to be pretty much LinkedIn, but 5 years before LinkedIn. So very, very bad in terms of timing. And in terms of what we did, we were actually selling to telecom operators, which is almost as hard, or perhaps even harder than selling to banks. And over the last few years also, I was one of the founding partners of Supercharger, which is the largest fintech accelerator in Asia, where amongst the 40 plus companies in the accelerator, 80% of them were selling to banks, banks or insurance companies like Standard Chartered or Allianz or etc. So my view here is really coming more from, I guess, a practitioner standpoint, both from large organizations and smaller organizations. And so in terms of, I guess, some of the points we'll talk about in terms of, working between large organizations and smaller organizations, and this collaboration, we know that in general, it's not obvious. And what I wanted to do is to just show a very simple, I guess, framework or model of what I think are the main reasons why it is not challenging in general. And across different things in terms of ways of working, business models, etc., I would say the main reason why it's hard is really around operating models, and the fact that operating models of large organizations versus small organizations is really different. So I'm sure that especially at Said, that you'd be looking at operating models in a lot of different ways. For me, the simplest way is really around PPT, people, process, and technology. And I think people, process, technology is really what differentiates large organizations from smaller organizations, and this is where there's this communication or challenges to work together. In terms of people, I tend to joke that usually the difference between having been in a large organizations and small organizations is that the main skills you need in a small organization is what I would call execution skills, the ability to make things happen very, very quickly. At the same time, in a large organization, that would be what I would call more political skills, the ability to navigate a large organization. So it's quite different in terms of the profiles of people, the way they think, and the different objectives. That's of course a bit simplified, but I think that's in terms of the types of people in large versus smaller organizations and their objectives, this is one of the biggest difference. The second thing is processes. And in large organizations need processes. When I used to be at Citi, for example, whatever we did, we needed a process. For example, if we wanted to launch a new product, there would be a new product approval committee, which is very, very clearly defined in terms of what needs to be done, who needs to approve, how do we get into this. For smaller organizations, most of the time it doesn't exist, but the hardest part is that it doesn't really exist in terms of processes to integrate small organizations into larger organizations. Just to give you an example, at CFT, we work with most of the tier 1 banks. What we do is that we provide courses, so which is we're not providing software, we're not providing any sensitive services. We provide courses, but at the end of the day, we would always go through some kind of vendor onboarding where we would need to demonstrate, for example, penetration testing on our software, etc., which is obviously what is which is not really what needs to be applied to our case. What we see also today in a world of much more open and partnership, and for example, smaller organizations partnering with larger organizations, usually there's no concept of partner in a large bank. You can be either a supplier, you can be a vendor, you can be a customer, but you can't be a partner. And so you don't fit into a process. So that's the second challenge. And the third one is in terms of technology in general, where we would know all the issues in terms of integrating legacy systems, the fact that large organizations don't necessarily have all the APIs, etc. So those are, I think, the three things to look at in terms of how can we try to make large organizations work with smaller organizations. Now, what works? And I wanted to show three examples of interesting collaborations that tend to work quite well. First one, Goldman Sachs, Kensho. You might be aware of Kensho, which is this company that does basically data analytics and machine learning. Basically, they started with an investment from Google and Goldman Sachs in 2014, were acquired by S&P. What worked in their case? A few things. The first thing is that very, very close collaboration with Goldman Sachs. So very early on, they co-created their product by almost being embedded on the trading floor of Goldman Sachs. They got an investment from Goldman Sachs also, and so they became almost like an R&D capacity for Goldman. So that worked well for them. Second one, Mosaic Smart Data, working with JP Morgan. Mosaic Smart Data, also artificial intelligence and machine learning, working on the trading floor of JP Morgan. Why did it work well? Two main reasons. The first one is that the founder of Mosaic Smart Data, Matt Hodgson, used to be a managing director in sales and trading at Deutsche Bank, so knows the industry extremely well, knows the technology and the processes extremely well. And very quickly, they also got an investment from JP Morgan. And finally, UOB, the Singaporean bank with Tukitaki. Tukitaki, machine learning for compliance, worked really well. They're also in production at UOB at the moment. Why did it work? Because Tukitaki managed, or basically started, as part of the accelerator of UOB, so very close to the organization, very, very early on. And the founder of Tukitaki is also an ex-JP Morgan, so also very, very familiar with the industry. So I would say, in general, we know some of the challenges in terms of people, process, and technology. What helps? Familiarity with the industry, having been in the industry, having an investment or being accelerated by the organization helps a lot, and doing co-creation from the beginning helps a lot. And just to finish, in terms of competition or collaboration in general, the 10 largest fintech funding rounds of 2019, 80% of them, they're all on the B2C side. So they're not really collaborating in general with large incumbents. They're basically either competing or creating new types of financial services. That means that although 80% of the companies of the fintech startups tend to be on the B2B side, their funding tends to be much, much smaller because they require less funding also. That will be a challenge over the next few years because of the crisis that we're having with COVID at the moment, which is morphing into a social and economic crisis, which means that a lot of the B2B startups might be struggling. Why? Because the priorities of the large organizations are shifting today in terms of business continuity and others. So for those companies that sell to large banks, I think some of them will do very well because they provide a service which is really key. But for some other ones which are not necessarily well capitalized, I think that's going to be quite challenging. So looking at all those issues in terms of operating model might be even perhaps more important today.
Very good. That was very interesting and stimulating opening comments. I think we're going to move through our panelists, and I was hoping that Jeff Lynn could be the next one. You happen to show up next to Hugh on the screen. And then actually, just to make it more predictable, after Jeff, I'll go to Silvio. I'll then go to Ben, and then I will go to Tzlilil. So hopefully that's a good order. Jeff, all yours.
Thanks very much, Thomas. Can you hear me all right?
Yes.
Excellent. And apologies, I have a 3-year-old in the background somewhere if the additional noise hits in. Hello, everybody. My name is Jeff Lynn. I am a co-founder and now chairman of a UK-based fintech business called Seedrs. We are a marketplace for investing in private companies, sometimes known as equity crowdfunding. We allow investors, large and small, to invest online in businesses that they choose, and we allow companies ranging from pre-seed to pre-IPO to raise capital in exchange for equity. We started working on the model for Seedrs in 2009 when I was actually a student at Said, along with my co-founder. And at the time, it was a highly innovative model. At least now there are a few other people who are doing it, but I'm pleased to say that we are one of the largest in the world. We funded about 1,000 deals, over 800 million pounds invested to date, and continuing to grow quickly. To put into context, I guess, my thoughts on the collaboration with incumbents, I would sort of start with an observation that I think that very broadly speaking, there are sort of two kinds of fintechs. There are fintechs that have creatively built technology that is meant to do things for or with incumbents. And then there are fintechs that are actually coming up with either disruptive or at least innovative business models that don't necessarily, have a natural fit with incumbents. And all of my comments, should be seen through the light of what I do, which is the second category. And so anything I'm about to say, I think, is not necessarily generally applicable, certainly not, to some of the businesses that Hui referenced as having established successful collaborations and many others. But within sort of our world of innovative business models, innovative forms of finance, I have, I have no sort of great ideology or research here, but I'll share a little bit of our experiences just as a narrative. And the sum total of it is we have not found collaboration with incumbents to be particularly practical. And the reason has tended to be that the kinds of things that we would like to collaborate on, the kinds of things that could add enough value for us to make the process of dealing with large institutions worthwhile, usually are the kinds of things that would create more risk for the incumbent than value that we can build at our size. That has been, for us, I think, the fundamental challenge. And I'll talk through two examples of that through our history that I think kind of illustrate it. So the first was when we were initially going to be going through regulatory process. So we came up with our idea, started working on it, and it was clear to us that this was a business model that would need, notwithstanding that hadn't been done before, it would need regulatory approval by the then FSA, Financial Services Authority, now the FCA. And in those days, we're talking 2009, 2010, this was long before sandboxes and Project Innovate and the various things that the UK regulator has now done to be welcoming to innovation. I always tell the story about having written a letter to the then chief executive of the FSA, who I had a contact with, saying, trying to say basically, this is what we're trying to work on, and be very, keen to explore with one of your senior policy people sort of what kind of considerations you might like to discuss and how we can do this best. And I got a letter back from the head of policy basically saying, thank you for your letter, no, goodbye. And that was, in essence, the position that the FSA had then. You could apply to them with a full application and everything that went into that, but there's no form of preliminary engagement in the way that there later would be. So that meant we were faced with a choice. We either had to go and do all of the work around building out the full model ourselves, satisfying all the regulatory conditions ourselves before we could even then go to the regulator, seek authorization, and launch the business. Or there was a potential other route, which was known as the appointed representative route. So in the UK, I don't know if there are parallels to this in other jurisdictions, but in the UK, there's a sort of bit of a cottage industry of firms that get, and are all perfectly above board and sanctioned, but firms that get, that act as umbrellas for small regulated entities. So they get a whole series of authorizations in place, and they then essentially lend those out. They appoint these small firms as their representatives, and this allows those firms, usually on a temporary basis, to operate, to conduct regulated activities, even before or usually during the pendency of their standalone application. And it's a very good model, and although whether or not you would necessarily classify these umbrella firms as incumbents, these aren't large banks. These are sort of, this is a bit of a specialized industry, but they very much have the mentality and approach of incumbent financial services players. They are conservative. They tend to be fairly traditional. They tend not to be sort of, very, very sort of versed in, or at least at the time, versed in the innovation space. But at the same time, they're always looking for business. They're always looking to bring in people as their appointed representatives. And so we had a number of conversations early on, trying to see if we could develop a relationship with one of them that would allow us to launch earlier. Eventually, we would have to get our own regulatory permissions, but we wanted to try to partner with one of these firms initially. And in the end, we got nowhere. And in the end, what we did wind up having to do was go down the authorization route entirely ourselves. And as a result, we had about a 2.5-year period from when we first started working on the business full time until we got authorized and were able to launch. It was a very long period to be a pre-launch business, and to raise capital and to do all the things that we needed to do. But I think the key thing that I would take away from the conversations we had and the failure to establish a relationship there was not that either of us did anything wrong, not that the umbrella firms were inappropriately closed-minded, not that we approached it wrong. I mean, obviously we did go to the FSA and get authorized, so our model did work. But the risk profile just wouldn't have made sense to the umbrella firms at the time. We were a new model. It was very tough to know at the time how the FSA would react to what we were doing. And for them, their entire business is based on the integrity of their licenses. So to take on us as a small client, whatever we were able to pay, tiny firm, small client, and jeopardize contaminating, in effect, the entirety of their license structure and therefore their entire business just wouldn't have been a particularly logical decision. And obviously I didn't appreciate that at the time, but in years since, looking back, it makes absolute sense, and I probably would have made the exact same decision. So that was one set of kind of incumbent partnership relationships that or attempted relationships that we had. Then the second is maybe more sort of on point, perhaps, to some of what I think is being talked about more broadly within this conference, which is the sort of relationship with banks. Soon after, we're in the equity space, and what's interesting about sort of equity financing of small businesses is that it is one of those areas of finance that the traditional banks don't touch, really never touched. We're not competitive to them. This is not something that any of them did. And therefore, without any particular competitive tension, there is, at least in spirit, the opportunity, or I think, a warmness towards some form of collaboration. And we pretty quickly realized after we launched our business and we're starting to grow, that there was a potential and quite obvious synergy, which was really in the form of customer referral. So you have, with many banks, two things that we really needed. Tiny business, at the time, and we're trying to grow both sides of our market, get deal flow in, get investors in. And so what do you have with banks? On one end, you have a whole lot of small businesses who come to them looking for loans and who simply aren't debt eligible. They are too speculative, they aren't asset backed. And in some cases, they're not financeable at all, but some subset of them actually would be equity financeable. Bank can't make it, can't lend the money, not credit worthy, but the growth story is sufficient that there is a really reasonable possibility of financing the early stages of business through equity. These banks, for a host of reasons, even though they're turning them down for the loan, would like to be able to do something nice for them, if for no other reason than just to build up a relationship with them as depositor, and then ultimately, when they get to scale, potentially on a credit basis. But there's also political pressure to be seen to be doing things for small businesses and others. So on one end, you've got this obvious thing: we need deal flow. Banks want to, potentially want to pass on rejected applicants to somebody who can finance them on the equity side. And then on the flip side, we need investors investing through our platform. And banks tend to have, many larger ones have wealth management or similar arms of some sort where they're representing, a whole number of prospective investors who are looking for opportunities to allocate their capital. And these businesses are a potential way of doing it. But the banks that are a potential investment opportunity, but the banks can't. It's not going to be efficient. It's not part of what the banks do to try to actually execute transactions between these sides. So natural thing to do would be to refer on investors, to us as well and help finance some of the businesses they're running. So in theory, this is great. And we got approached by, wound up forming partnerships. We had a number of conversations, wound up forming partnerships with two major banks, one UK, one European, in our first few years. And what happened there was it worked. But it only worked on one side, and that wasn't sufficient to make it work for scale. The referrals of businesses were fine. They were absolutely happy to pass any business on to us that they wanted. And a few of them would go on to raise some money, and there was a little bit of action there. But to really get this working, we needed both sides. We needed the investors as well. And that's where they became very guarded. And again, I think it became a risk decision for them. The risk profile of handing over a bunch of companies that they couldn't service anyway to us was essentially minimal, and they viewed that as an opportunity, with essentially no cost and only upside to them. But when you refer investors to anywhere else, or no matter through what structure and through what with what safeguards, when you put investors into investment opportunities, and they're high-risk investment opportunities, and there's a risk that something goes wrong, there is a level of potential risk that comes back to the entire financial institution. And I think that had we been bigger and had the amount of activity been enough that it could have really moved the needle for them, that's a risk decision that they could have taken on balance. But what their view, I believe, was, and again, as with the umbrella firms, I think not unsensibly, is that the amount of business in the short to medium term that they're going to be able to generate by doing this, or the amount of activity they can get relative to the risk of contamination across the entirety of the bank, just doesn't make it a worthwhile trade-off. So we always really struggled in those partnerships, both of which have effectively wound down now. We really struggled to get the bit of it that we needed to really make the whole thing work. So where does this all come out? Again, as I said at the beginning, this is not an ideological point for me, and I certainly do not come from the school that says that fintechs are all here to be disruptive and destroy the banks. I think where there are opportunities for collaboration with banks or other incumbent financial services players, I'd be the first to seize upon them. But I think based on the experiences we've seen so far, and based on the fact that I understand why we face the challenges that we have. You know, nowadays, as we look at where to allocate our limited resources and bandwidth, pursuing relationships with incumbents is low down the list, because I simply don't believe that it's likely that we're going to be able to make something really work it. So that's just a bit about our experience.
Thank you, Jeff. That was fascinating. Spoken like a true entrepreneur. Interestingly enough, the whole latter part of your comments focused on the potential interaction with banks. And in fact, our next two speakers will speak from the bank perspective. So even though it just happens randomly that my tiles are arranged this way, there is a great logic to it. And we're going to have two very different banks. So Silvio, maybe I'll hand over to you next, and the floor is yours.
Thank you very much, Thomas. And congrats for the landscape behind your shoulder. I think it's the best of the day. I mean, and respect another ones on ours. And,
thank you.
Thank you very much. Just some few words to introduce myself. I've been working for Intesa Sanpaolo Group for all my career, for all my working life, and I'm the CEO now. I'm the CEO of Banca 5, that I will introduce later on what is it and which special bank is it. In former times, I used to be in charge of all the operative part of the bank, which include IT departments, organization departments, back offices, cybersecurity, all the digital transformation. And before of that, I've been for many years the CIO of the group. So I come from a technology background, completely technology background, where I spent almost all my careers. And being at the end the CIO, then all the cost part, and now in this adventure, you also try to see the other side of the moon, the income part of the moon. So Banca 5, can I share my screen? Done? Okay, great. Just to go deeply through our business model, Banca 5 is a bank of Intesa Sanpaolo Group, 100% owned by Intesa Sanpaolo Group, that is a sort of a product factory of bank products that own products, liquidity products, and other simple products, and also distribute third-party products. But the peculiar point of this bank is that we do not have a distributed channels, but we use third-party distributed channels. So we didn't want to implement, we had, but then we dismiss some direct channels, but we use third-party ones. So our business model is based on a strong commercial partnership with product factories and distributed channels. So that means that our business model has changed very, very much, because we have to move from a normal bank, from a traditional model based on information, product, and channels to get the customer, to an API market. So we are a bank that don't have a front end, but our front end is a list of API, almost 70 API are live now. And we use these ones to go in our go-to-market model. This changed completely the mindset of our people, because also the organization that we need to face this type of model. And it's very challenging. We started from the beginning of this year. So that's the path that we are going. And also the revenue models is completely different, because it's not based on products, but it's based on APIs. And so what we are discovering that it's completely different to respect on traditional bank revenue model. And we are working on this. But the point is that I want to focus on is the two commercial partners, distributed commercial partner that we have now, that we use now. The first one, the biggest one, is called Cecil Pay. That is a new company founded in December 2019, some months ago, between a part of Banca 5, the physical network that we had, and Cecil Group, that is the leading betting company in Italy, that also had a very wide network. We built together a network of 50,000 touch points, physical touch points all around Italy, made of tobacconists, newsstands, bars, where citizens, where customers can go and have an instant banking operation, like withdrawals, like money transfer, like all the type of payments, and something like this. So this is for very simple products. We provide them products, and they manage all the network. They manage all the network in the physical and then digital way. The second partner that we distribute our product with is Oval Money. That's probably is much more fits with the thing that we are talking today. Oval Money is a fintech company. It's completely fintech company. It's a British-Italian company that save and invest money, that let customers to save and invest a small amount of money. It's a B2C company. And we decided to develop a partnership between them based on industrial purposes. What I mean with this, in my former experience, mainly the relationship and the collaboration between banks or big banks, big groups like Intesa Sanpaolo is with fintech was almost made of investments, made of financial purposes. We invest, we buy shares or participations, or we finance, and then get the benefits from the growth of this company. But there will never have been an experience made of in the combination of the two business model upon this industrial way. So we transformed our proposition in a white label proposition, in a bank as a platform proposition, giving the chance to Oval Money to have wallets, payment accounts, debit cards already done, completely personalized with the brand, with the colors of Oval, so that the customers don't perceive that there is a bank behind, but they think to work with a fintech, no? But we split the responsibility and the challenges between us. The more they will grow, the more that we will grow with them. The more we will grow, the more they will grow with us. But there are two different business models that can run separately. There's no need to go together, but one can go without each other. And being a big group, we also work with them with our venture capital, corporate venture capital. So we can also decide to finance them. Last but not the least, we also can provide them products in terms of company product, like insurance or financial product that they can need to distribute to their customers. So we use these two commercial customer partners that we have in production as an example to standardize our efforts, our products. And now what we want to do, based on these two ones, going to the market with our prospect. Who are our prospects? The prospects are utilities, corporate, let me just say corporate, other fintech like Oval or startups, whoever want to develop a B2C model and don't want to face the efforts of implement liquidity and wallets economy or wallets product that the single consumer will need. So we provide them in a very easy way and very quick way as well. So this is our business. So sorry for introducing this, but it was very important. Then I want to focus on what can be interesting for today. So the issue that we had when we faced the Oval part, because it was it was less difficult with Seasoned Pay because it was already a player on an Italian market. It's a big company, and Intesa Sanpaolo is a big company. So we put together two big companies, even with the regulators, was quite easy. I mean, it was normal. It's a normal dialogue. But with Oval, when a bank want to work, not want to finance, want to work together with a company, it was not easy path to go through, both for either for regulator, or even for inside the group. Before, we talk about an operating model. No, the point is the operating model, and I really agree with him. Even if he used TPP acronyms for us that we work in PSD2, TPP means another things. But anyway, technology, people, and processes can be good. And the point is to find the right agreement inside the group. And it is not easy at all in a big group to work with a different business model, because business model Banca 5 is completely different than the rest of Intesa Sanpaolo. So first of all, we have to set up a new contract with Oval Money, a partnership contract, and involving our legal departments on a brand new green field. And it took almost 2 months to do this. And 2 months because we were really focused to get focused to the target, as well as other 3 months to get all the agreement between all the control function inside the group and make understand to the compliance, to AML, to audit parts, audit functions, that this different business with respect on the others was interesting and was worth to go through. And so also organize themselves to anyway take control of this part. Then we faced to the regulator, and facing to the regulator, it was not easy at all, because we had to went there and explain what we want to do. Normal, but then it took 1 month. Then it came back. Then regulators going into details of what we're doing, asked for a clearance from ML group department to ask exactly why and what were the rules of what we were going to do. And it took other 2 months. And then we had to do a specific application, formal application, to externalize the access on our products. And that takes 3 months. The point is that each one of these single steps could also have a specific logical purpose, or there is an explanation why is needed. But the point is putting all together, it took us more than 12 months to get in production with this part. And 12 months, if you want to do on this type of business, it means that in the same 12 months with Oval Money, we change 3 times the way to be on the market. Because being a fintech, you try to be to go in a way. If the market answer to you in the proper in the same way that you want it, you go through and you go on. Otherwise, you change a little bit. So all the change needs too long timeline to get the answer. This is one of the real problems that we experiment. All the things that I've heard today about a regulatory approach, and I really underline that every day in the last few years we faced again this point. European rules different than Italian rules. Italian rules made on the other part. So then you face with the first regulator, but the second regulator used different method or different rules with respect on the first one. Then so it's very war, and very difficult. And so at the end of the day, the timeline is too long. So if you want to accelerate on this part, you need to facilitate the timeline, because in 12 months, I mean, there are, I don't know how many thousands of fintechs that grow and how many thousands of fintechs that completely burn out. And if you wanted to do at scale this part, because it is not a problem of only of experiments, of try to do an experience. The point is that you get advantages as a big group. You can put this thing at the scale, if you can bring them a scale. But if I need 12 months for each one of them, I would never get a scale. So this is a part of the experience we've done. Hope was interesting, will be interesting with the question you will have. So Thomas, the floor is back to you, and thank you very much.
Thanks very much. And so Silvio was sharing with us one experience in a bank. Ben, Barclays, very innovative, leading UK bank, but a very different approach, I think, to fintech. And in fact, there's quite a rich story that you can share with us. All yours.
Okay, thank you. First of all, can everyone hear me okay?
Yes.
Yeah, great. Okay, look, real pleasure to be with you all. So look, I'm hopefully going to provide a ray of hope for Jeff and Hugh. I sympathise 100% with what you've been through, and listening to Silvio, that's a fascinating model. We've got a different way of addressing your problem. So let's see. I'll come back to that in a minute. But essentially, think of me as running a startup at Barclays. That's what I do. It's called Barclays Ventures. It is a business unit designed to meet and answer all the challenges that you've thrown out there, all of which, by the way, I would 100% recognize and agree with. So very briefly, bit of background. I think Silvio started as a tech person and has moved his way through ops and into business. I'm not sure how you describe my journey, but I was a lawyer, had a wig and a gown, Chancery barrister for 7 years. I was then a FIG banker, so advised financial institutions, did a ton of stuff for governments during the financial crisis. I then somehow ended up being group head of strategy at Barclays, which I did for a couple of years. And as part of that, ended up with a bit of advocacy at the end of that stint, which basically said to them at the group ExCo level, look, we've got our strategy, we need to execute on that, but some part of the firm needs to look out in time, 5 years, needs to think about new technologies, new capabilities, needs to experiment with them now, and then allow some of these experiments, hopefully over time, to scale up into meaningful new businesses. And to do that, we need to be able to do 3 things. We need to be able to build ourselves, we need to be able to co-develop, and we need to be able to partner outside of Barclays, unencumbered by at least some of the rules and regulations that would otherwise apply. And whilst I wouldn't say we have home-rummed every single answer, we have made material progress, and I'm going to come back to that, if I may, in just a moment. The other thing, and I can't, we won't have time to explain why, I also now look after the group innovation team as well. Anecdote to one side, if you have a group innovation team, you've probably got a problem. We'll debate that one a little bit later on as well. So look, big picture. First of all, on collaboration models, I just wanted to just give you a little bit of context. I know I'm talking to a field of experts, so I do think this model has changed dramatically even in the last sort of 4 or 5 years. So go back to perhaps the start of Jeff's journey, by the sounds of it, sort of 4 or 5 years ago. It felt very much, I think, that fintechs and incumbents were on a separate path. There was a little bit of wariness probably between the 2 groupings. I think a number of fintechs had this vision of direct to consumer, direct to customer, hitting mega scale. What they did incredibly well was bring a totally new view on customer and customer experience, UX, and obviously best-in-class new technologies and fantastic teams. But typically they address very specific problems in the value chain very intelligently, and a handful of them have hit real scale, of course, which one of which is Jeff and Cedars, which I know very well. But in the grand scheme of thing, I would argue that the successes, the really standout successes, have been relatively limited and are the well-established names. The biggest issue, of course, has been the classic path to scale and distribution. Some academics talk about the chasm of adoption. You'll get your classic early adopters who are your enthusiasts, and they will go for it and they'll help you develop your product. They're wonderful to work with. They're not, unfortunately, the path to market success, although they can certainly help you on your way. What you've got to do is get to scale. And if nothing else, one of the advantages that incumbents have is scale and distribution and brand and cybersecurity and a whole host of other things. And the thesis that I'm going to roll out in a second is it is essential that the incumbents are able to bring those skill sets to the wider fintech community, and the fintech community bring all of the value that they can to really, I think, affect a transformation in the financial services market. And this current terrible set of circumstances may be exactly the environment to push that very hard. So that was 4 or 5 years ago. Stage 2, I would say, was a little bit of reality biting about 2 years ago. And what I'd argue is that there was a recognition of that chasm of adoption. And whilst maybe it's 10, maybe it's 20% of the fintechs were hitting scale, the vast majority weren't. And that has prompted a pretty dramatic shift, at least what I've seen, to B2B models. Strategic partnerships, but they are really hard. And therefore, in particular, and the panelists have already done a great job, but in particular, we know that onboarding and the procurement processes are a nightmare. we know that there are key KYC requirements, there are cybersecurity requirements, there are risk requirements, there are, goodness, if you ever get that far, live production constraints, and of course you have the regulations that obviously rightly provide some of the red lines around the entire process. So with that in mind, are we about to get into a stage 3 of the collaboration model? I think we might well be, partly prompted by the current circumstances. I personally can see from an incumbent's perspective even greater appreciation of the power of technology and collaboration. I can see boards, I can see senior executives saying, do you know what? Yes, there are risks to adoption, but frankly, are the risks of not adopting even greater? I can see there being an increasing emphasis on the criticality of self-service and automation. These are not new themes, but I do think that people's balance of judgment around the risks they're willing to take, coming back to one of the very first things that Jeff mentioned, I think may well be reevaluated in light of recent experience. From a fintech's perspective, I think these were well appreciated in stage 2. There is a real benefit of scale, brand, distribution, cybersecurity, risk management, compliance, and of course, funding and capital. And the incumbents, whilst they have some disadvantages, have obviously advantages in a number of those areas. So I personally think that Silvio's little guide around moving into a world of microservices, moving to an area of best of breed, where you don't have to wrap your arms around the entirety of your product offering. You can excel where you can, and you take someone else's microservice or partnership where they are truly world class. And personally, that's what I'm aiming for with the business that I run called Barclays Ventures. So what have we actually done to deal with the no-can-do units within our organization? Well, the short version is we had to start with risk and governance. And so fully appreciating the comments that have been made, what I ended up doing, and it was a bit painful to be frank, is redefined our risk and governance framework. We took 550 pages of dense paperwork and we turned it into roughly about 50 pages of outcome-based principles. We then created a technology zone, which is, you'll be pleased to hear, Jeff and Hugh, the rule is we don't build on legacy systems. We don't. Everything is cloud native, and as a result of which, we've got an environment that allows you to work with partners and scale analytics at some pace. We built a team that was led by deep technologists, data analytics, UX, UI. I have a number of founders already in my team. Astonishingly, they're about a quarter of my age. They have executive teams who are running the business, and they're working with me to teach me how to do it, which is great fun. But crucially, we've also changed our culture and way of working. And we have adopted one of my chief product and technology officer, whose CV, frankly, is just ridiculous, but was at Microsoft, Google, one of 7 CTOs at Disney, led their interactive division. He then worked personally for Bill Gates, and then more recently ran Amazon's advertising banner business. And somehow he ended up working with me. He is helping us completely re-engineer our way of working. And so we follow the Amazon backwards way of working. We have gates, we have systems. We never introduce capital until the milestones have been hit, and we try and kill stuff if they're not meeting our outcomes. And finally, we have a team that is actually empathetic with the challenges that a startup, be it fintech or other, is going through. We have, or we try to hold ourselves to account in terms of turnaround times, transparency of decision making, and we absolutely own the process of onboarding. Now, from all of that, we last year we did manage to onboard 20 partners. We have filed 8 patents in the last 12 months. We have generated our first revenue, and had we been having a discussion 3 weeks ago, I might even have been in market roundabout now with about 3 new products. Talk about that one another day, perhaps. But actually, jokes aside, I mean, what an extraordinary market to test the importance of partnership, digital channels, virtual engagement, both obviously for the day job, but frankly more just to help society in any way we can. So in that context, I listened to some of the conversation earlier on sandboxes. We need our regulators, and they have been great, I have to say, our regulators to appreciate that for this to really work, the incumbents have to be able to experiment safely, and that is not perfection. We've got to get away from an incumbent perspective. You know, we unfortunately have to hold almost the perfect record. And what we've been trying to do is say, look, it is more dangerous not to have experimented with groups of 10, with 20, with 50, with 100. If you're not allowed to step through those fairly carefully controlled experiments. What is the alternative? The answer is 3 years of development, £20 million, big bang, out you go and see what happens. So the regulatory sandboxes, I would argue, have a responsibility on behalf of the regulators to allow us to do just that. So look, all the points you're making on why it's so difficult, I 100% agree. Believe me, I've been holding the bits of paper to say, this is what we must do. And people say, absolutely no way. But we have made some good progress. And look, I hope as a result, this conversation and others will allow others to make the same sort of progress I hope we're making.
Ben, thank you. That was fascinating and a very dynamic view. Now, you know, the one that everybody always likes to dump on is obviously the regulator, and so it's still very courageous of you to face a group of entrepreneurs and bankers on the same panel. But you've been actually witnessing some very innovative approaches with sandboxes and other. So all over to you.
Okay, let me try to fix that.
All yours.
Perfect. Okay, so thank you. So first of all, I'm here because until quite recently, I was working for the Israeli Ministry of Justice. My field of responsibility were financial regulation and corporate governance, and among other things, I was the coordinator of an intergovernmental team consisting of all financial regulators in Israel that was working on establishing a sandbox in Israel. So I currently work at Israel Discount Bank, which is one of the commercial banks in Israel. But I should start with a disclaimer saying that all the views that I'm going to share with you guys, of course, are my view and not of any other official in the Israeli government. So if we look on sandboxes around the world, what we might see is that it kind of became a fashion. Like a lot of countries around the world are adopting this concept of a sandbox. I do think, however, that this comes out of a real need, not just the need of the industry, but also the need of the regulator. And if we look at Israel as an example, so Israel has a very strong high-tech culture. It's considered itself to be a startup nation with a lot of fintechs actually operating from Israel. But when you look on the numbers of how many of them actually provide services or products to the Israeli market, you get the ridiculous number of less than 25%, and I suspect this number is even lower. And our initial hypothesis about why is this so low was that, you know, those companies face very burden of the burden of regulation. The regulatory burden is a barrier to entry. But the results we were getting are quite different, actually. And while regulatory burden is indeed a problem for those companies in terms of compliance, especially that was mentioned here before, it's also being unregulated, which became a real barrier to entry for fintechs in Israel. And it might sound a bit weird, but in Israel, a lot of the fintech segment is actually unregulated, including payment institutions, for instance, that are regulated in all other parts of the world, but not yet in Israel. And being unregulated means that you don't have to comply with anti-money laundering laws. And this makes it really difficult for you to work with incumbent banks in Israel, for instance. And banks are really reluctant on, you know, managing accounts for those fintech firms. And so this becomes a real barrier to entry. And it brings me to the question of, you know, as a regulator, how do you even approach regulating innovation? And there's a lot of literature on this issue. Some of it was presented here today in the conference, and specific thanks for Professor Dirk Zetsche, that we were relying quite heavily on his work, actually. So he has a framework which I think is very accurate about how regulators in the world approach innovation. And I think the easiest thing is the do nothing approach. But of course, there is no regulator that is going to work and think, well, I'll do nothing today. But what they are doing is actually they're trying to learn and study the risks and the implications of the regulation that there are of the industry. And sometimes it just takes so long that you basically miss the train. So we have this example in Israel, unfortunately, with virtual assets. And in general, the blockchain technology in Israel, this is something that the regulators in Israel have been working on for the last 3 to 4 years, but still nothing there is no agreement about what should happen and what should be the regulation. And so this industry just fled away from Israel. And, you know, looking at how it looks today, this market, maybe that's not such a bad thing, but it's definitely not out of a regulatory choice. And the other end of the spectrum would be to regulate first before you fully understand the risks. Maybe you don't even know it. The problem with that is that can sometimes bring you to inefficient regulation, or maybe ones that are not even technology neutral. And if we take, for example, the access to account regulation in Israel, the API revolution that we had, in Israel, it was actually drafted literally almost overnight in the middle of another regulatory effort, and the result being such a sloppy regulation that can't really put into use. So the regulator is currently working on replacing that, but obviously still 3 years have passed and nothing has happened. And in the middle ground, you have all sorts of options of case-by-case regulation, of working with the industry, which sometimes can work if the business model is quite straightforward and technology is quite straightforward. So we've seen this with the P2P regulation in Israel, which was done on a quite fast track in terms of regulatory efforts. And we also have the sandbox, which is a very important tool when the regulator is dealing with unknown technology or business models. And it's really helpful because for regulators, dealing with innovation is not easy. No one wants to be the one that got a very wrong decision that, you know, impacted the whole industry and do it on his watch. And so the sandbox allows some kind of a confined environment where the regulators can make mistakes as well, but those mistakes are confined by nature, and this can help the regulator to be braver. And so I just want to run quickly on the policy consideration challenges that we had in Israel while thinking of designing the sandbox. I think the feature of the program are quite similar all over the world, so I don't want to focus on that. But I think the biggest advantage we saw as regulators in Israel was not just the fact that this program can help to foster the time to market of fintechs, but also that it could bring the regulator up to speed with everything that is happening. And it could make regulators to get more courageous decisions and be braver when they're approaching regulation. And I think the challenge here was that we have more than one financial regulator in Israel. And so the question was how to approach that. So in other countries, what they did was basically to establish a different program under each regulator. We were afraid that this was going to create kind of a race to the bottom. And so what we decided was to establish kind of a joint roundtable where all financial regulators have to decide on the company that is getting into the sandbox and decide together. So of course the lead regulator, which is the one that would actually license the company eventually, would have a veto right because we didn't want to compromise its independence. But still we thought that there is a benefit for all regulators sitting together, and this could also help prevent some cooperation problems later on, especially if more than one regulator is involved. The other challenge, which I think is quite important when you deal with innovation, maintaining consumers' trust. And the problem we had was that we had to do it on a budget. So in Israel, there is no deposit insurance or any other compensation schemes for clients of customers, as is the case in UK and other countries. And we didn't want to establish a specific scheme just for the sandbox because it would make it on budget considerations just unrealistic. So what we decided was to not allow the regulator to compromise on any laws that has to do with consumer protection. And this is a very partial solution because obviously companies can fail for all sorts of reasons, not just for consumer protection reasons. But yet we thought that we were hoping that this was at least gonna keep the money of those consumers safe, and therefore if one company fails, it would not affect all the other companies in the sandbox. And the third challenge, which was discussed quite heavily in this conference earlier, was how to expand the regulatory perimeter to those companies that are currently being unregulated. And I think this is very important because eventually, if we really want to get regulators to do smarter regulation, they need to see it coming. So they kind of need to be proactive and know the industry better. But it's really difficult to get to know the industry that you're not currently regulating. And so the way we thought we're going to deal with that was to establish a specific scheme for those companies which are currently unlicensed, when they can have some kind of a mentoring relationship with the regulator, get some comfort maybe about certain practices that they want to check, or maybe even confidence that they shouldn't be asking for a license if it's unclear. And on the regulatory perspective, this is of course giving the regulator access to companies that he usually is not going to see, therefore expanding his knowledge. But it also has a really strong benefit, I think, from the fintech side, because they get some kind of regulatory acknowledgement that, you know, this company has been someone do some due diligence on the regulator side for it, and therefore it can go with this acknowledgement and have better relationship with the incumbent banks. Because when banks do the risk, when they weigh the risk of this company, obviously it's less risky than other company which does not have any connection to the regulator. So with this, I think I'm short on time, so I would just say something about the future of this regulatory tool. I think today we talk about it as a very innovative tool that is used only in the, or mainly in the fintech area, but in the fintech arena. But I think that in the future, we're going to see this tool used in many other industry, and it might become just, you know, as any other regulatory tool, such as a waiver and no action. I think this tool is helping regulators to face things that they are not used to be facing. So this could be used, for instance, in the AI industry, in smart transportation. This is not confined to the financial industry, in my opinion, although it started there. But most importantly, I think that when we examine the success of those programs in the world, we have a tendency to look over the number of companies that graduated from the sandbox program or the shortening of time to market. While I think what we really should be looking at is, did it really change the way regulators think? Did it help us to create proactive and faster regulation and smarter ones, which are, let's say, more in line with the technology revolution that we are experiencing? And I think the real challenge here is to create this new generation of more courageous regulators that are not afraid from technology. And I think this is on my part. Thank you.